It looks like they're back in the markets, baby. However bad the past year was, the big dogs don't seem to care. Could it be the reopening of China and the outlook of new capital inflows? Is it inflation that's cooling off while economic conditions are loosening? What lurks underneath is far more interesting.
Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal.
A reopening means a spike in inflation, which was evidently shown in EU and the US. So is China next to follow?
There's still a lot of uncertainty on the growth picture globally. So I think we're in the same spot where I think we see equities down in the near term, possibly recovering towards the end of the year.
From here, we extrapolate if we're safe to throw all our capital at the markets, and if that would do us any good. And welcome back to Black Boulder. Today's episode is going to be a real mind bender, folks. You see, we've got a lot of conflicting forces in the markets, and we got to figure out what that's all about. No easy task for some, but we'll make it look like squeezing lemons. So, let's take a peek at what to expect today. We'll start off with the market news recap of the week. China's amazing inflation report, US CPI of last Thursday, that same day as the China inflation report, defiant bulls who stood up to the Fed with a trillion market rally, and Elon out there slashing Tesla pricing, while Tim Cook slashing his pay. What a generous guy. Continuing the episode, we'll jump into chart analysis. Gonna have a little investigation on these charts, starting with the dollar, which tested the breakout once. Let's see if we get a second confirmation or a follow through. The 10-year yields broke through the sloping channel. This might further an opening to fall back to the multi-year support. The SPX got over 4K. Let's see if that holds. We got the NASDAQ riding the wave of oversold tech stocks. What do we see and what can we expect? And as last, Tesla, the hot name. Do we get a breakout to the upside with the help of fundamentals, or will the cascade continue? Following up with the conclusion of this video and my initial thoughts for this week. Without any further holdup, let's start this episode off. Market news. So let's get going with China's amazing inflation report, which wasn't amazing at all. Inflation is moving higher after all, and is probably going to accelerate in the months ahead, as it's been evident in the US and the EU after this grandiose reopening. But to be absolutely sure that it might be the case, we need to keep track of it for the next few reports. But for now, let's take a listen at the head of Asia Pacific Wealth Management of Morgan Stanley.
Good morning, Steve. Thank you for being with us today at our GAIN conference. The 8th time we are doing that it was absent last year because of the COVID measures. Now we are back. We have about 400 people at Ritz-Carlton here. Yes, I am in the camp of being constructive about the impact of reopening of China and Hong Kong to the rest of the world. I think one reason why I think the world, we may be a bit underestimating the impact is because of lack of travel. Remember, Hong Kong really only completely reverted to openness on the 29th of December, and China only about a week or so ago. So therefore, how many people really were back to China, or for Hong Kong for that matter? And because we have a lot of people living in China, we have a lot of colleagues traveling to China all the time, we can hear from them the direct impact of the reopening and what happened in terms of COVID cycle and the impact on people and people's attitude towards that. And that gives me a lot of confidence.
How did US inflation report fare that same day? Well, a bit better. It's still moving down, but not as sharp as it's been climbing. A year-over-year decrease of 0.6% on CPI and a year-over-year decrease of 0.3% in core CPI. However, if we look at the month-over-month data, it's barely moving down to the point that core inflation has even moved up. Whoa. If we look at the easing conditions in the US market and a sticky core inflation, it might be a matter of time until the next report comes out fiery hot and the Fed won't have any other choice than to go raising those rates again. It only gets worse with this next article. Defiant bulls standing up to the Fed has never been a smart move, and instead of defiant bulls, how about a stubborn pullback in the market from oversold technicals and a decrease in interest rate hikes plus marginally lower inflation? I think that will be a better headline. To blow this up to these kinds of proportions, I wouldn't get too hasty and trigger all the moms and pops to waste their money in this unconfirmed bull rally. At least, not yet. Closing off this recap with two very rich and very powerful individuals seen slashing things. One of them is cutting prices on its product, seeing his market share shrivel, and so trying to recapture that flag and a potential further blast to the company's sales in Tesla. The other one is strategically declining a 40% pay so that money stays in the company, which will grow his share to a larger degree than his essential payout in the coming months. And then you could just yoink his stocks from the market. Genius. I mean, real fucking genius. Trade with Mr. Cook and get your money as well. Don't buy his iPhone though. Sly silver fox. And take a listen to this Bloomberg reporter. He obviously knows Tim Cook, and so from now on, we're gonna call him Timmy.
Is cutting CEO Tim Cook's compensation by 40% in 2023. Why? Anders Mellon is our Bloomberg wealth reporter. Anders, good to see you. Timmy's taking a pay cut. 40% sounds like a whopping chop, but then we've got to compare it to stock performance, and how will they incentivize him to stay? Good morning.
Moving on to the chart analysis to see if we can spot these potential trillion-dollar moves. And kicking it off with our old buddy, the USD on the daily chart. As we've discussed in the last episode, it has been in a consolidating state after falling below the daily 200 SMA. Right after we've seen the dollar breaking out of this consolidation and resuming its move to the downside. While this is quite bearish, I still want to be sure if this move will be sustained into this week. So far, the MACD is showing us a new bearish momentum is about to start on the daily chart, which could drive the dollar towards 101 and plunging it further to the multi-year resistance turned support at 98. The RSI could support a further move to the downside, although I would be much more satisfied if it would start a move from 45. This might create some room for the market move without getting oversold too quickly. What we're probably about to see in the next few days is the dollar trying to recover some ground until it reaches 102.5, 103 before getting dumped again, resetting the indicators to a more comfortable state from where it could proceed towards the next support, which would be 101. So let's pop the hood and take a look at the engine, the 10-year yields, weekly chart. And the market pulled back down to its current soft trend line at the last low of December 2022, leaving a red impression for the week, but currently lacking conviction to break the support, as well as the trend line to give us a further confirmation of a longer pullback. However, the indicators leave enough room for the market to break those levels, and thus rally afterwards to retest that break and further resuming its move to the downside. For now, and zooming in on the daily, our first thing to watch would be the attraction of the 200 SMA or the complete disdain of that level. This would mark a further increase or decrease in US indices and is about to be put to a test on the 4-hour chart. If the market manages to suppress the 10-year yield and keeps it underneath the 200 SMA on the 4-hour chart, sellers might step in and push the yields towards the daily chart's 200 SMA, thus breaking the current soft trend line and confirming an ABC pattern, forcing the yields back to its next level of support. And so how will all of this impact the indices? Let's take a look at the S&P 500 and the NASDAQ real quick. First off, the S&P on the weekly chart. Everything looks real good, and the weekly chart seems to be ripping to the upside after finding buyers around the level of 3,800. I don't wonder why. I mean, we just seen the article. None of the indicators point towards stalling the current rally, as the RSI is gaining energy and the MACD is pushing the bullish momentum into a positive territory, forcing its way towards 4K but not yet closing above that level with some good old bullish pressure. Don't get me wrong, the weekly candle is all what bullishness is about, but without proper volume, I'm not yet fully convinced. And focusing on the daily chart, we seem to have crossed the 200 SMA. Keeping above this line will be crucial for the bulls to make a further statement towards the upside. Let's take an even closer look at the 4-hour chart. It seems more than possible for the indices to retreat on Wednesday towards 3,900, 3,950 and staying above the 200 SMA, just to check if it could bring in some fresh buyers to proceed its way back into the channel, marked with the thin red lines. The NASDAQ is already front-running this move and regained its ground back into the channel. Starting off with a weekly chart, again, a wonderful bullish move bouncing off the support line and off the channel, as well as gaining its footing above our precious 200 SMA, not only on the weekly, but also on the 4-hour chart, which we'll get into in a minute. It's more apparent on the NASDAQ that the market could just grasp above the moving support and resistance, and so this can erupt the battle for the 200 SMA on the weekly chart this week. A move below, followed by an uplift from the buyers, would force the buyers towards the upper channel resistance in the coming weeks. As I'm regarding the past month's breakout to the downside as a fake out, which mostly ends up flipping the scenario and doing the same thing on the opposite side of the set channel. I'm more inclined to get bullish in this kind of environment until the market gives us a clear path towards a potential downside by breaking out this pullback and therefore the channel. And finally, as we get to the king of meme stocks, Tesla, the weekly chart. And what do we have here? A phenomenal year it had, for the bears of course. I mean, everyone was shorting this stock. To be totally honest with you, Tesla's market share has dropped more than 7% last year, year over year. This number is based on the last 3 quarters of vehicle sales compared to other EV companies. And so Elon's trying to slash the pricing of Teslas to boost its sales and gain back some ground. To be clear, the weekly chart is translating that positively by following up with a green impression after a rejection of the level of 100. For more bullish upkeep for Tesla, the buyers would have to sustain the market above 122 and subsequently push it towards 165 and 170, where the 200 SMA of the weekly chart lies, providing the first resistance. Keeping underneath this line will force the market back down to 100, but breaking above and actually finding support will force the market all the way to 200 to 220. Where the sloping resistance is located. For now, on the 4-hourly chart, we'll keep in mind that 122 will be our support for the time being, and if the market keeps above this price level, as mentioned before, we will see a further uplift. As for my closing thoughts, I think this week will be a semi-lackluster week, especially for the indices. If you look at NASDAQ, the main job it has to do is to keep above the weekly 200 SMA to actually succeed in a bullish run the next week. If not, well, You know how the story goes. We've already seen it. It'll probably bounce off the sloping multi-week resistance and continue to the downside. But I don't expect it to happen, especially if the dollar is still heading towards the support. And so far, until it hasn't reached that point, we will not see the indices crash. That is it for today, people. I hope you enjoyed the episode. If you found it any knowledgeable at all, put some call options on the like and subscribe button. Until next time, see ya.
That van's gonna rear end that taxi.
What?
The driver's distracted. He's texting. He's going 30 miles an hour. He's 60 feet to stop. He doesn't have room.
What van?
I see everything, Carl. I'm 50 moves ahead of you and everybody else.